You're listening to Seattle Real Estate Podcast.
Hey everybody, I'm Sean Reynolds, the owner of Summit Properties Northwest, Reynolds & Kline Appraisal, and your host of this episode of the Seattle Real Estate Podcast. With me today, joining me again today, is Mr. Dan Chapman from Fairway Independent Mortgage. Dan, thanks so much for being on the show.
Yeah, great to be back, Sean. Thanks for having me.
I thought what we do today is we've had a bunch of questions come up from our YouTube channel, and people are posting comments and asking questions. And we had a couple that I thought about trying to answer, and I'm like, this is not my wheelhouse. I'm going to have Dan take a look at some of these questions. So what we're going to do is we are going to look at how you do an interest rate lock for your mortgage, what that looks like, what ordering out an appraisal. We had somebody who's super concerned about having an appraiser come into their house, and they wanted to kind of be able to control that process, but they weren't having any luck. So how does an appraisal get ordered out? We're going to cover that. And then we're also you've got a jumbo loan update for us. I've had a number of questions of people who are like, hey, doesn't look like the jumbo markets are moving much at all. And so what's going on? How many lenders are there? And am I going to be able to sell this listing at $2.2 million? So we're going to cover all that. So Dan, thanks again for jumping on with us. Let's go with the rate lock. And so tell us about that process. At what point in time can you lock in your interest rate on the mortgage process?
Okay, well, purchase right away. You can lock it right away. Refinance, actually, for a while there, we were waiting till the loan was approved, but now we're back to you can lock it right away. Typically, your average lock is for 30 days. You can lock for 15 or you can lock 45, 60, but average is about 30 days.
And do you pay more for a longer lock?
Yeah, a longer lock is more expensive on the rate pricing. So, for example, if it's a $500,000 loan, and you were locking at, say, no points on a 30-day lock, it's not quite no points on a 45. It might cost you $500. So
okay. And do you spend that money even if you bail on that? Say you pull your loan from that lender and you go with another lender. What happens to the money that you're supposed to pay on that rate lock?
Yeah, good question. They just don't like us to cancel locks. We can't cancel it unless we can't switch investors like that unless we just can't.
What if the borrower? What I'm talking about is the borrower decides they want to go with a different lender.
Got you. Yeah, that's just cancels. No, it's fine. It's actually us more money to lend to somebody else on our warehouse lines. So most of the locks are with Fannie Mae and Freddie Mac direct because we're a direct lender, so we're locking them directly with them. Okay. If you have to cancel, you cancel. If obviously that doesn't happen very often, but once in a while. Okay. And another question I had was, can people get sued if they don't follow through with their rate lock? No. I mean, from us, the lender?
By anybody.
Yeah, no, I wouldn't be worried about that at all. The only thing that a client may have, if we're getting a lot of appraisal waivers, especially refinance, so there's no cost. They can get out of it if they want to. Obviously, if we're locking, we'd like them to commit to the loan. There's a it's a loan commitment, but there's no legal ramifications from our end. Then if they pay for the appraisal up front, if there is an appraisal and they pay for it up front, then they pay for it, and we're not losing any money that way.
Right. But they may not be able to use that appraisal on the next deal if they pull the deal and go on to the next lender.
Correct. That most likely they will not be able to.
Because each lender basically has to order their own appraisal, and that's to ensure that there's appraisal independence. You're not picking your best friend who happens to be an appraiser and getting a really high value.
Yeah, exactly. So as you know, Sean, we have an appraisal management company. Ours is called FLS for short, and they order the appraisals. We send in the order to them. They pick the appraiser, like your company's on our list, obviously. So it's kind of a round robin thing, and they pick the appraiser. And of course, appraisers can, say, hey, I'm too busy, or if it's an area they don't go in, they can decline it, or they can just say, hey, we'll take it.
Turn it down, and it gets sent to the next guy on the list.
Exactly.
Yep. Okay. So somebody has they've got their application in, they've locked their rate, interest rates drop. Now we've had that recently, and I think you're going to see some more of that. What happens to that original rate lock that you had? Can you relock? Can you float down? Tell me about that.
Yeah. So a rate lock is, when we're locking a rate, say this did happen, Sean, in early March, mid-March. We were locking for 60 days. Rates went down. I did a lot of float downs. So we can float a rate down even on a refinance. The rates have to drop by at least 0.25%.
Okay.
So if you lock a rate and you lock at, say, 3% and that rate goes to 2.75, we can request a float down and they can get a lower rate. So
if it's an eighth drop, doesn't count, quarter point is what you have
exactly.
to have.
It's got to be at least a quarter.
Okay. That makes sense. And does that cost anything more, or you're talking the rate float down?
That cost us more.
It costs you guys more. Does it cost the consumer more?
Nope.
Okay.
Now there could be a difference. Say they wanted that 0.25% rate drop and they were, it's 0.25% rate drop at no points, but there could be a small fee charged depending on rate pricing at that 0.25% drop. So if they had no points and now they're on a $500,000 loan, their quarter point now, that could be, that's $1,250. That it doesn't mean it's going to be that way. It just depends on rate pricing when they float down. But it's got to be a benefit to the borrower, and it's got to be at least a quarter point rate.
Okay. When is the best time within the loan process to lock that rate? What advice would you have for somebody who's like, all right, I'm going to do this refinance?
That's a really detailed question. I mean, for one thing right now, rates are super low, right? So if it's a purchase and it's closing inside of 30 days, typically right now I'm locking when I get that loan in the system, because the client, they're like, oh, this is a great rate. If it's a refinance or if it's a longer closing on a purchase, I can advise the client based on what the market's doing and try to get that lock ideally, inside of 30 days.
Okay.
But it just depends on what the benefit to the borrower is too, and how mortgage rates are trading in the mortgage market. So, but for the most part, like I've got purchases coming in right now, and if it's under 30 days, I'm locking. If it's outside of 30 days, then it just depends on the client and what if the client wants it, they are happy with it, then sometimes you just need to lock.
Then you just take it.
Rely on me for advice.
Okay. So what you're saying is if rates are really low and it's what you want, go ahead and lock it no matter where you are in the process. Because I hear a lot of people talking about, well, I've been calling my loan officer and I'm just not quite sure when to lock my rate. What do you think? And they ask a million different people. And of course, they get a million different answers. So I kind of just wanted to hear your thoughts on.
Yeah, it's a little different on a refinance, but because you don't have a timeline to close.
Right, because there's no set date on a refinance.
Yeah, I've got a bunch of people right now waiting for because their loan is above the conventional limit, the national limit of 510, 400. Okay. So Seattle market, obviously, it's called high balance. They can go to 741, 750, and I've got a bunch of people in that $600,000 to $700,000 range that are looking for a little bit lower rate, like an eighth lower rate, with no closing cost. So I got a bunch of those locked, not locked, but approved, waiting to lock. And those people are being patient. I said, hey, just be patient. It's going to happen, probably within the next couple of weeks. So.
Okay. So just sit tight. It'll happen. Keep an eye out. I'll let you know when to go. And then when you do have somebody who knows what they're doing mortgage wise, then it's super important to listen to their advice. If they're telling you lock your rate, what do? You lock that rate, right?
Yeah. And I try to get some people to say, hey, if it's a refinance and we hit this, do you want me to lock you? So I don't even have to contact them. I just say, hey, your loan's locked. We hit it.
So you've basically got instructions in the file. Okay, this is what we're going to do.
Yeah, that's what I try to get on a refinance, especially.
Okay. So once you have the instructions and you go ahead, how do you actually do a rate lock on your end? What does that look like?
Oh, it's just you're in the loan application system that we use. You're in there and you pull up the rates and it tells you what the pricing is. if it's say 3 1/8, you just hit the lock button, and it tells you if it's Fannie Mae or Freddie Mac loan. It tells you right then and there.
Okay. So it's pretty basic on your end.
Very basic. Yeah. Really easy.
Okay. All right. I think we've covered that pretty well. Anything else you can think of on rate lock that would be of interest to consumers or people out there looking for a refinance or a purchase?
I mean, just the main thing is, you're going to get lenders that are going to quote you. I get this all the time. I got 2.75 on a 30-year fix. Can you do it? Yeah. Can I see that estimate? Because it's going to have some closing costs on there.
Yeah.
And a lot of borrowers, they may not understand, what they're paying on that. So just know that sometimes, if it sounds too good to be true, sometimes it is.
It is. Yeah. Right. Yeah. Because most loans are very, very similar because everybody's getting loans from, the wholesale lenders. And so there's not that much variation. So when you hear people saying, oh, I got this great deal, like you said, there's something going on. There's something in there that they have paid for that makes their rate essentially higher.
Yeah. Essentially with most lenders, rates are going to be within 1/8 of each other.
Super close. Yeah. Okay. Cool. Thank you on that, Dan. All right. So let's talk about the order out process and the appraisal. I had a person on YouTube, and their situation is that they had a pre-existing health condition. I think it was maybe cancer survivor, and they want to do a refinance, but they did not want to have an appraiser come in the home. Or if the appraiser did come in the home, they wanted the appraiser to wear maybe a hazmat suit, take some real precautions because they really want to do the refinance, but they were having a tough time getting a commitment from any number of lenders they were checking out. All the lenders were saying is that you have to apply for a loan in order for us to figure out what kind of appraisal you're going to get. So can you walk me through the appraisal process from your end? What does that look like? And how can somebody figure this out?
Yeah. So what we do is we get their application. You're right. They do have to apply. We don't have to have like every financial that they have, but we have to pull a credit report. And then we need to know, accurate data, obviously address, estimated value that we think the value of the home is worth, and income. You need to be pretty accurate on the income part. And, the more equity they have in the property and the lower their debt to income ratio, the better chances they have getting a property inspection waiver or an appraisal waiver. So we don't need one. I'd say probably 75% of the refinances I've done this year have not needed an appraisal on a conventional loan.
Wow. Yeah. Okay. How about during the pandemic? Because on the appraisal end, we're still doing a ton of, basically we're exclusively doing full inspections, meaning we're going inside every single home.
Absolutely. On a refinance, if we don't get an appraisal waiver, it is a full appraisal.
Yeah. And that's basically a Fannie Mae, Freddie Mac, which are federally, guided companies. So we can't do anything about that. You as the lender can't do anything about that. And also the consumer can't do anything about that. It is what it is.
Yeah. And you're not doing many exterior only, are you guys?
We've done only a handful.
Yeah. Very rare.
Yeah. Pretty rare. So it seems like it's either a full appraisal or it's an appraisal waiver.
Exactly. Totally. Yep.
Okay. And so when you you get all this information from the client, and then you go to submit that information. And at what point in time do you get the findings for what kind of appraisal it's going to be?
Oh yeah. Usually we'll know, once we submit that, we'll know right away because Fannie Mae, it's an automated thing from Fannie Mae and Freddie Mac.
Okay.
Get the loan file, and the next day we run automated underwriting findings. We're going to know right then and there if we need an appraisal or not.
Okay. And then, and like we said, it could be anything from a waiver to an exterior only inspection to a full inspection, any one of number of those things.
On purchases, it could be any one of those three. Finances, it's only been either a waiver or a full appraisal.
Nothing in between.
Nope.
Yeah. I think it's so interesting that Fannie Mae and Freddie Mac, which are federally regulated companies, have basically said, we care more about our assets than we do the perceived health of either the inhabitants of the home or the appraiser going into it. We've got this whole lockdown thing, but you guys, we still need you to go into the home.
Yeah, you're right. For the most part, I think that's pretty accurate.
Yeah, for 99% of the business going on out there, it's kind of like, hey, guys, figure it out. And, on the appraisal end, it's just one person going into a home. So you can kind of figure that out. But if you have a whole bunch of people who've been staying at home for a long time, ask them if they're going to randomly walk into some stranger's home.
Right. Yeah, no, you're right.
Not happening.
It's a little interesting because you can list a home and you can allow one realtor in at a time. I think it's one, maybe. It depends on.
It's one in Washington right now in phase 1, and it goes to still one real estate agent and then 2 people at the beginning of phase 2, but we have no idea when our phase 2 is going to start.
So I would imagine when appraiser from your company is going into a property, are they wearing a mask or what are they? Yeah. Mask,
gloves, footies, kind of depending on the appraiser and the request from the client. But yeah, for sure. Any of that stuff. We're also on purchases, we're requesting that the seller be gone because we can hit up the real estate agent and just say, hey, just want the agent in there, no people.
That makes sense.
Because the less interaction you have, the better, especially for these situations where you've got somebody who's got pre-existing conditions, and we want to respect that as much as possible. And so I basically told the person who was asking the question on YouTube, hey, maybe there is a chance that the appraiser is going to have to wear a hazmat suit to make you feel more comfortable about this process, but offer to pay them a little bit more because that's kind of an out of the ordinary request, something, that severe. But, in that case, get a, one-time use hazmat suit, put it on, walk through the home, take your pictures, do what you need to do. It can be done.
Yeah. I mean, if they're wearing gloves and a mask, I mean, that's going to, you take the gloves off when you throw them away, when you walk out of the house,
Yep. Go wash your hands.
Yep.
Yeah. Just all that common sense stuff. But it is weird when you go through somebody's house, if you're taking a picture in a bedroom that the light isn't on, you got to hit that light switch. And just out of habit, you just go like that. And you're like, oh, glad I got the gloves on because otherwise I'm just touching this with my raw finger. And raw finger, that doesn't sound good. It sounds like hamburger.
That's a good point, though, Sean. You could say, hey, I'm coming out. I'm going to be here at this time. If you could have all the lights on in all the rooms, that would be helpful.
Lights on in all the rooms, doors open so you don't have to hit a doorknob. Just super basic stuff. But not everybody's on board with the stay at home. There's a lot of people that are just out and about and they're not going to stay 6 feet away from you because in their head, there's no threat. And that's happening a lot. And so a lot of this is kind of just people's personal preference. So you just got to, I think, explain. If you're the homeowner, you got to explain to the appraiser, here's what we're doing. And if you're the appraiser and you've got somebody who doesn't appear to be respecting the social distancing, you just let them know, hey, these are the conditions I'm willing to work under. And if you don't want to do that, we'll reschedule.
Yep.
Okay, so along the lines of this, I've got also another question, and you and I have been talking at the beginning of kind of the whole shutdown. A lot of the almost all of the jumbo lenders left the marketplace. There was no jumbo lending for like a couple of weeks, 3 weeks, maybe a month, something like that?
Yeah, I'd say about 4 weeks, yeah.
4 weeks, and slowly lenders have been re-entering the marketplace. I think Salal Credit Union was the first.
Yep, they were the first for us.
And now you've told me, I think late last week, there are some more lenders coming into the marketplace. Tell me about that.
Yeah, we've gotten a few. I guess the one that we do the most business with would be Chase, JP Morgan Chase. So that's really good because their rates are very competitive. We underwrite to them in-house at Fairway. We've gotten 5 total right now.
5, okay.
Yeah,
okay. Basically
everybody's at 20% down right now. So baby steps, right?
Yeah, right. So 20% down. What's the credit score?
720 minimum.
So 720 minimum and up to a maximum of 1.5 million.
That's right, 1.5 million. So you can purchase a house for 1.8 with 20% down. You can still purchase a house for $2 million, but you're gonna have to put $500K down. So
$500K down on top of.
No, if you bought a place for $2 million, obviously $500K down, because the max loan amount is $1.5 million.
Whatever it takes to beat it down to $1.5 million.
Yeah, exactly. Yep.
Okay. So Mary Austin and I were, hey, Mary, shout out to Mary because you know Dan as well. Mary Austin, real estate broker here in the Seattle area, she was asking about the viability of sales within a specific market, within the Kirkland market, which you know well. And she was asking, hey, above, a certain price point, what do you think? And I was kind of like, well, over the course of the last couple of months, there's been almost no closed sales, but we've got some pending transactions going on, which leads me to believe that buyers are finding these jumbo lenders. There's a little bit more liquidity in the jumbo lending market, and that coincides with what you're saying as well.
Yeah, I think the more we get back to the normal on the loan scenario stuff where they can borrow up to 2 or 2.5 million, the more that's going to help the jumbo market on the east side. And also, as we get further out of COVID and the stock market recovers, if you're working for Microsoft or Amazon and Facebook or whatever, you've got all these shares that, are maybe down, I don't know what they're down, but let's say 10, 15% from where they were before COVID. You're hoping to get some of that back before you have to sell. And a lot of people are exercising those shares and selling them for part of their down payment or all of it.
Okay. So a lot of the tech workers, especially here in the Seattle market where you work in as well, are dependent upon their down payment from liquidating shares of the company they work for. And so you're going to see less of that when those shares are way down and more buying power as the stock market increases and their shares are worth more.
Yep, exactly.
Okay. Anything else on the jumbo market that we should know, lender-wise or restrictions, or just kind of how that's going? And why jumbo lenders specifically? Why were they shut down, or why did they choose to shut down? Kind of walk us through that. First
off, I would say that if you're self-employed, you got to be very careful and make sure, in fact, I would recommend, unless you're self-employed, like in the techie industry or some industry where you you can work from home and you're always essential.
Okay.
Then you should get an approval ahead of time for you. Because, if a loan officer pre-approves you may not get approved. So you got to be really careful if you're self-employed and you're doing a jumbo loan.
So you need more. So if you're a self-employed, and we've had that come up, it's like, oh my gosh, Sean, did you know that the jumbo market is basically non-existent? And I'm like, yes, I did. I did a podcast with Dan Chapman on that. And we talked about it. So more than just a pre-approval, you basically need to go through more of the underwriting process to figure out if you're going to be able to get a loan if you're self-employed and you're looking.
I would do it for sure if you're self-employed. W-2, not really necessary if you're in a business that, like, say, Facebook, Amazon, Microsoft, something like that. But if you're self-employed, I would go for the full credit approval instead of your pre-approval. That's number one, what I would do.
And is that, Dan, because the lenders are looking at self-employed income as maybe possibly not being stable down the road for the next, say, 30 years, because that's the term of the mortgage you're signing up for?
Yeah, I mean, for sure that they're looking, at it closely. Like, what's the business doing now? Hey, what's your year-to-date profit and loss statement like? Have you filed 2019? If not, what did that profit and loss look like? But yeah, they're going to look at that very closely. So, jumbo investors get, it's a lot of money they're loaning out. And they get, at a really low interest rate too. So it's not like it's a big return on their investment.
They're they're taking a lot more risk than your standard loan.
For sure.
Yes.
So how much reserves do you have in the bank? How much money do you have after the down payment? If something gets bad, how long would you be able to make payments for without, being late or being late ever?
Right. And it's because you're borrowing a large amount of money, and they want to know, all right, this borrower needs to be solid in order for us to feel comfortable making this loan. That's kind of the bottom line.
Yep, exactly.
Okay. And Dan, another adjunct to that is you were mentioning before the podcast, some lessening of restrictions just on the standard mortgage lending as well?
Yeah, so cash out refinances are definitely not as strict as they once were. We raised our credit score requirement for a while on conventional loans and even FHA.
From what to what?
On FHA for a while we went up to 660, then then it was 640, and now we're down to 620 on all minimum credit score on all loans, conventional or FHA.
Okay.
So we're back down to 620, which is 620 is not a very good credit score. So they're going to look at other factors and see, is your debt to income ratio low? Make sure that's low. Is your job solid? But yeah, less strict. And then cash out refinances are a 660 credit score now, minimum.
Okay, so we are seeing the trend on the other side of the shutdown, which is kind of like reopening, less restrictions, less credit score, less down payment in some cases, that kind of thing.
Yep. So starting to get better.
Okay, well, that's what we like to hear. And my concern is that people are just going to be too freaked out to buy a house. But so far in May, I mean, I think we've had some pretty amazing activity. What are you seeing out there?
Yeah, we're fortunate in the Seattle market, Sean. Our economy is, as you know, I mean, if you take out Amazon and Microsoft, it's a totally different economy, right? In the Seattle market. And we're talking different story right now. But, fortunately, the economy in Seattle is very strong, despite COVID and the shutdown. Once we get back to work as normal, and hopefully that's soon, right?
Yes. Agreed. Sooner than later.
Pretty soon, because there are a lot of people hurting for money in businesses right now. But we're very fortunate in that aspect. And I'm seeing a lot of activity right now. A lot of buyers. I've had a few contracts come in last week for purchases. I think as we get further along, it's like we talked about earlier, I think August and September of this year are going to be really busy compared to normal.
We're going to have that shift from the time period of when the outbreak happened. That time period is going to be pushed into summer, which is usually kind of slower. But because people didn't have that opportunity to get out and about and look at stuff and, maybe kick the tires on a few homes, I agree. It's going to be a weird summer. It's going to especially be a weird late summer.
It's been a weird year. Everything about 2020.
We were doing so well in January and the first half of March, and then the wheels just came off the cart.
Yeah, it's just been wild. I tell people, are we in the twilight zone? I show my age when I say that, but
yeah, I know, because you and I have gone through not a pandemic, but we've gone through some pretty gnarly economic stuff.
Yeah, 2008.
Yeah, 2008, the big one. Tech crash of 2001 for me. And I started earlier than that, but so many of these were not as severe as this one because it was just boom, you're shut down.
Yeah. And this is totally different. Like for me, I feel really blessed, because like 2008, very little business, very little money that nobody was lending in 2008. We're still doing a ton of business. Our business is up about 75% from last year.
That's crazy. Yeah. Well, I hope it continues. And I keep seeing story after story after story from all the different news outlets that the one glimmer of hope in all of this is housing. There was such little supply to begin with, and we've still got minimal supply, but there's enough buyers out there to basically keep this market going. And I don't think you're going to see any major price drops. In fact, I think you're going to see some price increases, which sounds crazy, but those are the dynamics.
I've got a client today making an offer, and there's multiple offers on the property in Seattle. So in that $800K range, several offers. Rates are super low. Rates
are super low.
It's so great right now. And I tell clients, they ask me this question, do you think we're going to have a crash? And I was like, you know what? I don't see a crash. It could go down 2 to 3% over the next year or two. That's the max I see it happening. And, as long as you're not selling within the next 3-4 years, you're going to be in great position, I think.
You're going to be in good shape. Yep. And interest rates are so low.
Yep. I mean, you're talking about 3% on a 30-year fixed, roughly.
Those are just amazing numbers.
Yeah.
Well, Dan, thank you so much for coming on. How can people get a hold of you that want to get some more information from you? Maybe they're looking for a loan or a purchase. Tell us what areas you cover. Like what?
Yeah, I mean, I cover all of Washington State, California, Colorado, soon to be Montana. But right now, Washington State's where I do most of my business, California and Colorado. You can get me at danchapmanloans.com. That has all my information on it, danchapmanloans.com.
danchapmanloans.com. You make it easy.
Yep.
All right. Well, thanks so much again, Dan. Always appreciate your information. And people really look to our kind of podcasts for, this is kind of like, boots on the ground information. It's not exciting. It's not sexy, but it's an ongoing story of, hey, how can I get a loan? So thanks so much for being with us today and sharing your information.
Hey, thanks for having me, Sean. Talk soon.
All right. Sounds good, Dan. Thanks again. We'll catch up soon. All right. Bye-bye. Thanks again for tuning into this episode of the Seattle Real Estate Podcast. For those of you on YouTube, love to have you subscribe. And for those of you on our podcast platforms, thanks so much for listening. We'll catch you on the next one. Thank you. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.